Welcome back to the Deep Dive. Today, we are digging into one of the most polarizing earnings reports this quarter, the Q3 2025 update from Flutter Entertainment, ticker FLUT.
That's right. And they're the parent company of FanDuel, of course, and the world's largest online wagering operator.
And what a quarter. It was just completely fascinating, but you really couldn't call it clean.
No, not at all. This was the absolute epitome of a mixed print. I mean, on the one hand, you had this spectacular adjusted profit beat.
A huge beat.
Huge. But on the other, a towering GAAP net loss that would make, any investor take a step back.
So our mission today is to really unpack that, right? Isolate what's driving that split and, more importantly, figure out the cost of their big new strategic pivot into prediction markets.
Exactly. That's the key.
Okay, so let's start with the headline numbers because they really do tell two completely different stories. Give us the bad news first. How big was that net loss?
The headline, shocker, and the first thing everyone saw was the GAAP loss. The GAAP EPS came in at negative $3.91.
Wow. And in dollar terms.
That translates to a net loss of $690 million.
Nearly $700 million. But as you said, that was immediately countered by the adjusted numbers. So where did the non-GAAP figure land?
Well, the non-GAAP or adjusted EPS, that was the major surprise. It clocked in at $1.64.
Wait a second. Street consensus was sitting somewhere in the 60 to 80 cent range, right?
It was. This was a beat of over 100%.
That kind of profit beat usually sends a stock soaring. So what was going on under the hood?
We'll get to the operational levers in a second, mostly iGaming. But first, a quick look at the top line. Revenue was $3.794 billion.
Which was actually a small miss, wasn't it?
A very slight miss, yeah, maybe 1% to 2% short of consensus. But the foundational engagement is still very strong. Group average monthly players, or AMPs, grew robustly, up 9% year over year.
So more customers, but a profit picture that's just fractured by these huge one-time events.
Precisely.
Okay, so let's peel back that curtain. We have to reconcile the massive GAAP loss with that incredible adjusted profit. What caused the $700 million hole?
The drivers were really specific, and crucially, they were mostly non-cash events.
Okay.
The single biggest factor, which was the bulk of that loss, was a $556 million non-cash impairment charge.
And that was tied to India, right?
Exactly. It was related to the sudden shutdown of their real money gaming operation in India, specifically their jungly rummy business.
$500 million write-down. Was this expected at all?
The risk was known, but not the speed. This was due to new, fast-tracked legislation that just, effectively shut down real money gaming there.
To a harsh reminder of regulatory risks.
A very harsh reminder. They had to pull the plug immediately, and boom, there's your massive impairment charge.
What was the other major contributor to the GAAP loss? I remember there was a second big piece.
There was. The second headwind was all about the U.S. market access terms with Boyd Gaming. This involved about $204 million in non-cash transaction charges from restructuring the contract, plus a pretty substantial $205 million cash payment that actually went out the door during the quarter.
So if you strip away those one-offs, you start to see the real strength that drove the adjusted beat. Where was the operational performance just absolutely crushing it?
The engine room is, without a doubt, iGaming and the international segment. In the U.S., iGaming performance was, as management put it, exceptional.
By how much?
Revenue was up a massive 44% year over year, and that was supported by really robust 30% AMP growth.
And they talked about their own content, too.
They did. What's really notable is the success of their proprietary content. They specifically highlighted a new game, Huff and Lots of Puff.
Right.
It apparently set record engagement levels and gross revenue. And that's a fantastic example of the power of, owning your own content pipeline.
That is a huge competitive advantage. So what about the international business? Same story.
Absolutely. International revenue was up 21% year over year. And this was largely driven by really successful M&A integrations.
Like in Brazil.
Exactly. We saw standout performance in Brazil, which grew an incredible 412% year over year. And that includes the acquisition of BetNational. Southern Europe and Africa also jumped 101%, mostly thanks to SNAI in Italy.
Okay, so the casino side and international expansion are firing on all cylinders, which basically covered the weaknesses elsewhere.
It really did.
But we have to talk about the sportsbook. It's the public face of FanDuel, and the numbers suggest that whole segment faced some serious headwinds.
It did, yeah. Despite the growth in players, U.S. sportsbook revenue actually declined 5% year over year.
And that came from margin pressure.
Two key pressures. First, margin compression. The sportsbook net revenue margin hit 7.4%, which is down 80 basis points year over year.
What drove that? Was it just bad luck?
You could call it that. Management estimated a $45 million impact came simply from customer-friendly NFL results.
Haha. So the public won.
Basically, yeah. The volatility early in the season didn't favor the house. Great news if you hit your weekend parlay, though.
And the second pressure point, the competition.
That was it. Q3, especially at the start of the NFL season, saw rivals engaging in what management called exceptionally high levels of competitor generosity.
Which is just a nice way of saying they were spending a ton of money.
It's analysts speak for deeply uneconomic promotional spend.
Yeah.
Just trying to buy customers.
So rivals were buying market share, and FanDuel held the line.
Exactly. It temporarily impacted their handle growth, but they maintained a disciplined approach, and they stressed that's key for long-term profit. And they still reported a commanding 47% net gaming revenue market share in September.
That 47% share is a great anchor. Okay, before we get to strategy, let's talk balance sheet. That $205 million cash payment to Boyd must have hurt.
Oh, this is a critical area and a source of a lot of investor anxiety. That cash drain it crushed free cash flow.
How bad was it?
It plummeted 78% year over year, settling at just $25 million for the quarter.
Wow.
And the consequence of that was significantly higher leverage. Net debt ballooned to $10.6 billion.
Which pushed their leverage ratio to what?
It jumped to 4.0 times.
Yeah.
Which is a huge increase from 2.2 times at the end of last year.
And their target is what, 2.0 to 2.5x?
Exactly. So hitting 4.0x puts them way outside their comfort zone.
Okay, let's shift from the numbers to forward strategy. The biggest flashpoint of the call was clearly this huge high-stakes pivot into prediction markets. Tell us about FanDuel Predicts.
This is an incredibly ambitious and very expensive move. It's slated for December. The core strategy is to use this event contract platform to unlock a new TAM.
A new total addressable market.
Right. By operating in U.S. states that don't have regulated sports betting yet. It's a land grab.
Okay, but the big fear with prediction markets is always cannibalization, right? Will this new thing just siphon off revenue from the high-margin sportsbook?
Management was adamant on this point. They are confident it will have a, and I'm quoting, negligible impact on the core regulated business.
And their argument is what? That the products are different enough.
It's a structural argument. Customers in regulated states prefer the deeper, more complex bets. Live betting, same-game parlays, which prediction markets just can't replicate. They see it as pure growth.
It's a massive commitment, though. What's the price tag on this launch?
The investment is substantial. It's expected to reduce adjusted EBITDA by $40 to $50 million in Q4 of this year alone.
Just for one quarter.
Just for one quarter. And looking into 2026, the hit gets much bigger. We're talking a range of $200 to $300 million for the full year.
And there was a direct operational consequence to this, wasn't there? Something about Nevada.
Correct. To launch Predicts, the company had to surrender its Nevada gaming license.
Which is a big symbolic move.
It is. It really underscores the compliance trade-off they're making. They're prioritizing this massive potential TAM over a legacy license in a core state.
So you add up the bad sports results, the India shutdown, and this huge Predicts investment. It forced them to reset their full-year guidance. By how much?
The total impact was a $380 million reduction to their adjusted EBITDA midpoint. The new guidance for the full year is now $2.915 billion.
Down from almost $3.3 billion. That's a big cut.
It is. And it's driven almost entirely by the costs of this strategic pivot and increased investment to maintain that sportsbook dominance.
But despite all that, the guidance cut, the leverage, management sounded really unwavering on their long-term vision, especially on capital allocation.
They absolutely stood by it. They reiterated their target for a 16% sportsbook hold. Wow. And crucially, they reaffirmed their very aggressive capital return program.
The $5 billion buyback.
That's the one. They've already bought back over $1 billion worth with another $250 million planned for Q1 next year. That sends a very clear signal of their conviction in the equity.
Okay, which brings us to the investor context. The stock's reaction was kind of muted, right? Roughly flat after the call, despite that gigantic EPS beat. Why the caution?
Well, what's fascinating here is that the market was already really sensitive. The stock was already trading 27% below its 52-week high before the call.
Because of worries about leverage and competition from other prediction markets.
Exactly. The Kalshi shock, all of that. So investors are caught in this dilemma. They see the strong iGaming performance and the promise of a bigger TAM, but they're weighing that against this huge upfront investment and a 4.0 times leverage ratio.
So the question has shifted from can they win to how fast can they pay for all this?
Precisely.
Okay. Let's transition now to our This Is Not Financial Advice segment. We're putting on our structural hedge fund analyst hat. What's the outrageous but plausible trade idea here?
So let's analyze the financial engineering. Our thesis is that the market is obsessing over the temporary equity volatility and the cost of predicts, and it's completely mispricing the balance sheet.
Go on.
Management has been crystal clear. They have extremely high conviction in the equity backed by that multi-billion-dollar buyback, even while leverage is peaking at 4.0x.
So they're prioritizing the stock price.
They're explicitly prioritizing the stock price, which provides a sort of implicit floor and actually improves the long-term credit profile, even if they're borrowing more today.
Okay, I see the disconnect. So what's the trade?
We implement a relative value trade. You simultaneously short the long-term debt of Flutter, or a proxy credit instrument, while going long the equity.
Shorting the bonds while buying the stock. Explain how that works for people who aren't deep in fixed income.
Right. The rationale is all about that structural commitment. They're prioritizing equity. So if management executes on their cost targets and normalizes cash flow, that deleveraging story getting back down to their 2.0x target is going to happen faster than the credit markets realize.
Because the credit markets are just seeing 4.0x leverage and freaking out.
Exactly. They're demanding a high-risk premium on the debt. As the company proves out the strategy and deleverages, that risk premium spread between the debt and the equity will have to compress. And that means you can profit from both sides of the trade.
A very sophisticated play. Okay, that brings us to the end of our deep dive.
So to recap, Flutter delivered a quarter that was strategically critical but financially very mixed. You had exceptional iGaming and international growth offset by that regulatory hit in India, tough sports results, and the high-cost entrance into prediction markets.
And here's the final provocative thought for you to explore on your own. Management successfully argued that the prediction market is an additive TAM that won't cannibalize their core business. That's the whole growth thesis. However, that $556 million write-down in India was a stark, immediate reminder of regulatory risk. So if one country can wipe out a major asset in a single quarter by political fiat, how confident are you that the unregulated U.S. prediction market space won't face its own sudden regulatory hurdles down the line?
Something to watch very, very closely.
Thank you for joining us for this deep dive into Flutter Entertainment. Connect with us. Let us know what stood out to you. We'll see you next time.